Hey, Raph here, Zatara Transaction Advisors, zataratransactions.com. And I just wanted to go over kind of how we calculate working capital for M&A purposes. So we use the Monty Walker method. And basically, accountants, how they calculate it for accounting purposes, working capital is defined as current accounts or current assets minus current liabilities, and that's going to give you working capital. For M&A purposes, that may not be relevant, right? So I just wanted to kind of go over how we do it. So there's certain things we exclude from our working capital calculation because they're not relevant to the operation of the business, right? So we exclude cash and cash equivalents because um, they're not necessarily needed to run the business, right? We exclude short-term investments and short-term loans. We exclude owner receivables. We exclude employee receivables and advances. And we exclude excess inventory that was purchased as an investment. What we do include, though, is the accounts receivable, the inventory. So that's the retail, raw materials, work in process, work in progress, finished goods, other, and then costs in excess of billings and prepaid expenses, right? So we do include those. So like a deposit on real estate would be a prepaid expense, right? Prepaid rent. And then for liabilities, we exclude certain elements that accountants might include. So accrued interest, unearned revenue that's held in cash, right? So if a customer prepays for a service and you haven't done the service, right, that's held in cash, and we exclude that. The overdrafts account accrued interest will remove customer deposits, current maturities on long-term debt, current deposits on or unearned revenue, dividends payable, income taxes payable, interest payable, payroll taxes payable, short-term notes payable, and sales taxes payable. So all those things are excluded from our working capital calculation. What's included is the accounts payable, the accrued expenses, unearned revenue that's held in accounts receivable, right? Customer deposits that are deployed, and then billings in excess of costs. So all those things are included in the current liabilities for working capital. So I just kind of wanted to go over that. Inevitably, every transaction that has a working capital adjustment, unless it's already negotiated, if the accountants are going to fight over something, they're going to fight over this working capital calculation. So this is how we calculate it. This is how the accountant should be calculating it. Obviously, the seller's accountant is going to want the working capital as small as possible, right? And then the buyer's accountant is going to want it as large as possible. And so the buyer's accountant is going to include absolutely everything because they want to show that, hey, no, we need this much working capital. Whereas the seller's accountant is going to say, no, you don't need this, you don't need that, you don't need that, you don't need that. And so inevitably, every deal is going to get hung up on this working capital. But if you calculate it with the Monty Walker method, it's pretty straightforward, and that'll give you the actual amount of working capital required to run the business, right? One thing that could be removed from this is excess inventory. It's somewhat part of that inventory investment, but excess inventory is something that you could remove from this to better calculate the working capital. All that being said, if the seller wants it all gone and the buyer's willing to take it on, right? Then the buyer and seller have already agreed on how much working capital is to be included in the transaction. So there's nothing really for the accountants to argue about. So anyways, just wanted to do that quick working capital calculation. If you need help with the transaction, let me know, Raph at zataratransactions.com. And yeah, God bless you. Take care. Bye now.